We've already established how to select an efficient portfolio. That portfolio's got the highest possible expected return for some given level of risk. Next, what we need to do is to establish which portfolios are actually chosen by investors. So when we do efficient portfolio selection, we detail a number of different portfolios that are optimal in the sense of the highest expected return per unit of risk. Now what we need to do is to choose amongst those many portfolios which portfolio is the best for the particular investor at hand. So it turns out that in order to do this, we need to know something about risk aversion. Risk aversion is the investor's preference for risk. Sometimes we refer to risk tolerance. Risk tolerance is the inverse of risk aversion. So a person that is very risk averse has a very low tolerance for risk. A person that has a high tolerance for risk has low risk aversion. So we're going to use the concept of risk aversion to select a portfolio that is not just efficient, but is optimal for the particular individual. Now you can imagine now that different individuals have different tastes for risk. For example, somebody on fixed income, perhaps retired, has probably a high risk aversion. So that portfolio would have lower volatility than perhaps somebody just starting out in their career who has many years to retirement, and that person would be more willing to take on riskier investments. Now, let me emphasize here that we assume that everybody is risk averse. If you're willing to take on riskier investments, that simply means that you are risk averse, but you're more tolerant to taking on higher risk investments. The person on the fixed income perhaps is not that tolerant because they cannot afford to take a large loss, which might be a result of taking a risky portfolio. So risk aversion is the key here. And there's many different ways to determine an investor's risk aversion. Really, risk aversion is within the framework of utility theory. So everybody has got a particular utility function, and one of the parameters of that utility function is the parameter of relative risk aversion. Now, of course, the problem here is, what is the utility function? And there are courses that you can take in terms of decision theory where part of that course is to determine a person's risk aversion. So by a series of questions, a researcher can deduce approximately what the risk aversion is for the particular investor. In finance, often what we do is to put it a little differently. So an investor might be asked, what sort of risk are you willing to take in terms of portfolio volatility? So often in portfolio selection, the investor will say, well, I'm willing to take 15% standard deviation on an annual basis. What sort of portfolio does this imply for me? So I think that's perhaps the most logical way to proceed. But let's think about the mean standard deviation analysis and what this actually means in terms of portfolio choice. We developed in previous clips this idea that we would trade off risk and return in an efficient manner, and with many assets we'll get a parabola. And the parabola is in expected return on the y-axis and standard deviation on the x-axis space. It's a parabola, and we only really care about the upward sloping portion of that parabola. Those portfolios represent the maximum possible expected return per unit of risk. The whole parabola represents the set of minimum variance portfolios. So only the positively sloped portion represents efficient portfolios. And this means that if you take on extra risk in terms of standard deviation, you are rewarded in terms of extra expected return. So the positively sloped portion of this frontier is exactly what we would think from intuition should characterize the portfolio choice. You take on more risk, you get a higher expected return. So we will work there from the minimum risk point, which is sometimes called the minimum variance or minimum standard deviation portfolio, all the way out to portfolios that take on perhaps an extraordinary amount of risk. Now the question is, which portfolio is optimal? Well, a simple way of doing it, as I said, would be given that the investor has a taste for 15% standard deviation, what is the portfolio? And we could read the weights of that portfolio right out of a standard mean variance analysis. In terms of framing it in the context of risk aversion, we appeal to material that you've already learned in, I guess, the microeconomics course, in terms of indifference curves. So there'd be a series of indifference curves that characterize an investor's preferences. Now, if those indifference curves are very steeply sloped, that implies that in order to get the investor to take on a little more risk in terms of standard deviation, the expected return jump has to be quite large. So to take on a little bit more standard deviation, you have to have associated with it a very large expected reward. So those are steeply sloped indifference curves. And the optimal point in terms of the tangency with the minimum variance frontier will probably be very close to the minimum variance, the global minimum variance point. So the person that's got this very steep trade-off between risk and return will choose portfolios, efficient portfolios, that have very low standard deviation. Now the other person might have more tolerance for risk. That means that to get this person to take on a little extra standard deviation, this person doesn't require a huge reward in terms of expected return. There must be a reward, but it doesn't have to be large. So risk aversion says that if you take on more risk, there must be extra expected return. And what we're talking about is how much extra expected return. So this investor's indifference curves are more flat. They're still sloping the upward way, but they're a little more flat. And this suggests that the tangency point should be in the region where standard deviation is larger. So we can see that we can use the same tools that we used in microeconomics to derive the optimal portfolio for a particular individual. As I said, there's I guess a difference in naming convention. We can do efficient portfolios using a mathematical program that referred to as a nonlinear quadratic program. This gives us a set of thousands of portfolio that are efficient in the sense of getting the maximum possible expected return per unit of standard deviation. The next step is to determine which one of these 1,000 portfolios is optimal for the particular investor. And each investor could be different in this case. So we need the tools of indifference analysis, or we could do it the more direct way by choosing just a standard deviation. If we do this, we hit the optimal portfolio, the portfolio that is best for that particular investor.